Jim Harbaugh is a very famous coach. His deferred compensation package made national news back when they created it for him several years ago. And I'd say the first thing I would stress about this before I explain how it works is that this is not a product, it is a strategy. And a lot of institutions use this. It could be a university, a private business, a corporation, and yeah, it can even be a family. So it's not common practice though for a normal family, the normal income levels to be using it, because often the policies are too small to be able to create an attractive loan. So for this setup with the Jim Harbaugh situation, he was being paid a salary, and in addition to his salary, they offered him this type of deferred compensation through what is called a split dollar plan. And they assisted this plan by using it to set it up with life insurance. In a split dollar plan, there's an employer and an employee, and they have a written agreement that outlines how are they going to share the premium costs, what's the cash value going to contribute to, what's the death benefit. These are all aspects of that life insurance policy and the agreement that they have to construct. But employers do use these quite a bit to provide a supplemental benefit to kind of help retain those key employees. So the agreement in itself, it's going to lay out what the employee needs to accomplish, how long is the plan going to stay in effect, and also how is it going to be terminated. So this situation here with Jim Harbaugh is that the University of Michigan agreed to make 7 loan advances of $2 million each year, and that money would be used by Harbaugh to pay the premiums on a life insurance policy. So why would he want to do this? Why would Michigan want to do this? Well, the first reason is that for Michigan, it gives them more control over where he goes or can go without having some level of repercussions. So Michigan's playing the long game here, as most employers who implement these are. I also see them for companies that are buying out an organization, and when they're getting purchased, the people that are selling the companies, they don't necessarily want that massive amount of money coming into them right away. They want to find a way to stretch it out in different strategies so that the benefits extend for longer periods of time. Also, they don't want the tax right up front like that. So for Harbaugh, his benefit while living is going to be a little bit down the road, say 20 years from the start date of the policy. But if he passes away before that time period, there's going to be a death benefit. And that death benefit would be proceeds paid out to his family. And also for the University of Michigan, they're going to get their loan paid off. So that money is going to go back to them. So this is where it benefits both of the parties. The bigger thing is that if Harbaugh lives to see those benefits, what will happen is that the cash value that is accumulating inside of the life insurance policy, it is going to be put to use in some way. So it's either going to receive dividends annually, like in a whole life policy, or it's going to participate in an index or outright in the market. So these policies that are used in these programs, they're structured because they want to pay the highest premium for the lowest amount of death benefit, because this approach is going to minimize the policy charges, and it's going to allow the policy's cash value to grow as rapidly as possible with the least amount of drag. So drag being the cost of the insurance. But in the meantime, that policy's cash value in excess of the loan balance, that's where Harbaugh comes in, and he can access that income as a loan against the policy, which becomes tax-free income that he supplements in retirement. And then at the end of everything, you're hoping that it nets down to zero. So in simple terms, think of it as an arrangement where the employer is funding a Roth IRA, and there's a death benefit wrapper in there as a bonus.
Gotcha. It's just a very complicated one, but very cool. And thanks for breaking that down. And it sounds like it's a good deal for both parties. Yeah.
They always look great on paper at plan inception. Why would you do them otherwise? But I mean, eventually their success, it's going to depend on a lot of different factors that are going to be related both to economic performance, interest rates. It's going to be the employer and employee circumstances over time. I mean, I'm sure the University of Michigan has the funds to pay this premium and pay the loan, but corporations sometimes don't. Sometimes things happen. So you want to make sure there's a lot of confidence in the ability to pay those premiums initially, because you're going to be paying them for at least several years to start, maybe longer, depending on how you structure them. So it's very, very important to think about all the other things that are involved before you go into one of these strategies.
The content in this show is developed from sources believed to be providing accurate information. The information on this show is not intended as tax, legal, or direct financial advice. Please consult a qualified professional in these areas before taking any action regarding your individual situation.